I think the similar time periods would obviously be the early 1970s. Another time period would be the, excuse me, the late 1990s. And we know what happened with gold from 2001 to 2011. It was a major bull market. The reason I think we can compare to those big time periods, those big moves in gold and gold stocks before, is because of just how beat up most mining stocks have been, especially the juniors. I mean, a lot of these companies, they're sitting on actual resources, proven and probable resources, and they're trading for literally pennies on the dollar. I mean, they are literally dirt cheap. I mean, it's amazing.
Yeah.
So I think, that's why it's fair to compare to these other time periods because they're just so depressed and just any positive movement of funds into the industry, into the junior sector is really going to ignite them.
Welcome back to Metals and Miners. I'm its founder and its host, Gary Bohm. Today we have a fantastic discussion lined up, and we're fortunate to have with us Jeff Clark. Jeff is a second-generation mining prospector. At one point, the family owned mining claims in California, Arizona, and Nevada. He's the founder of thegoldadvisor.com, speaks regularly at precious metals conferences, and serves on the advisory board of Strategic Wealth Preservation. Jeff, thank you so much for joining us today.
Gary, it's great to be here. Thanks for having me on.
So let's begin with rate cuts. At today's press conference at Jackson Hole, Wyoming, Fed Chair Powell stated a shift in Fed policy is coming. If and when the Fed cuts rates, Jeff, what do you expect for the gold price and why?
I read some of the excerpts from Jerome Powell's, comments there, and he was more dovish than I think even a lot of people expected. So very dovish outlook. Rates cuts are coming. That's why virtually everything is up today, including gold. Gold does respond to a rate cut environment. When rates are declining or being cut, gold responds to that. So we have liftoff. We've had liftoff since gold broke through, 2000, 2100 there and stayed above it. We had a floor at 2400. Now we're above 2500. For me, I don't like to make predictions, but it would not surprise me in the least to see gold at 2,800 this year, maybe 3,000 at the outside. And keep in mind that September is gold's best month on average of the year. Going back all the way to 1970, if you average gold's price movements on a monthly basis, September is by far clearly the best performing month. So now we've had quite a run here in August, but with that backdrop, the Fed turning dovish, September being a strong seasonal month, those things tell me that gold is going higher. Keep in mind, a lot of people have been on vacation. Trading volumes in mining stocks have been low. We've seen fewer visits on our site. Simply because of the summer. So, you add all this up, and I expect things to really turn around here and for gold to be strong for the rest of the year.
Wonderful. So, Jeff, the economic data, it's deteriorating. If the U.S. enters recession, what do you anticipate happening to gold in that situation?
That's a good question because a lot of people think we are going to have a recession, and I think that's partly what Jerome Powell's comments were referring to as weak economic indicators. So it is important that we look at what gold normally does in a recession, and it normally rises. If you go back to the last 8 recessions, all the way back to the 1970s, gold has typically risen during a recession. Which makes sense when you think about it. There's uncertainty and fear and, who knows what's going to happen. And that, of course, drives people into gold as a safe haven asset. So it's not, too surprising that gold does rise. But if we have that ahead of us as well, plus the there's so many other catalysts out there, the election, geopolitics, uh, are they going to turn to money printing again and all those kinds of things. So you add all that up, and I think, we do have a strong season for gold, really in play right now.
So what is the recent move in gold? Busting through first of all the consolidation from the last 4 years, but then busting through the all-time highs, and once again continuing its upward march after several months of consolidation. What is the move in gold telling you from the last 6 months?
Well, that obviously that means demand is much higher. There's a lot more buyers than there are sellers. So the reason for that has been multiple reasons. It all kickstarted back on leap year day back in February when the market was surprised to hear the Fed may cut interest rates. Remember, they said they're going to cut rates 4 times this year and all that. That changed since that time, but that's what kickstarted all of it. Then you had geopolitical issues. Then you had political issues. You had concerns about debt, concerns about the economy not being as strong as people thought. You had the yen carry trade unwinding. That led to the crash in gold last month or several weeks ago. But it rebounded immediately after that because that was a liquidity event. Gold got sold, but it bounced back immediately because gold is a safe haven asset. So that's what tends to happen in those circumstances. So there's been a whole number of reasons that gold has risen and made new highs and stayed at new highs. And the crazy thing is, all the reasons that gold could rise, not all of them have played out yet. There's more that can yet come. So, this is all a very positive backdrop for gold. And it does tell you people are concerned, people are worried, investors want more exposure to gold. That's very positive, but it tells us the same thing, that we as private personal investors should have meaningful exposure to gold as well.
So, Jeff, recently you wrote an article and you stated, I'm calling it, the countdown to when money starts flowing into the junior stocks has begun. So what are you seeing that you feel so confident to make that call?
So there's a lot of reasons that someone could make that claim, that the fuse has been lit, that money will flow into juniors. It's just a matter of time now. So some people thought, well, I'm making that call because of the relentlessly higher rising gold price, right? Or the Fed cutting rates, maybe a recession, if we have a stock market decline, if we're going to go into monetary easing. There's a lot of reasons that someone could make that claim. I made that claim for none of those reasons. I made it simply because of what Q2 financial results showed from the producing gold companies. And what they showed was a very significant jump in earnings and cash flow. We monitored basically the top 6 gold producers, and all 6 of them reported significantly higher earnings, very significant higher cash flows. Only one company was flat in cash flow. They all rose a tremendous amount, double digits, triple digits, and even in cash flow with, I think it was Newmont. Their cash flow change year over year was 1,388% higher over just 12 months. And that is solely because of the higher gold price. Think about it. We had inflation happening during this whole time. It's been high, rising. It's been hitting miners harder. It's been hitting their feasibility studies hard. We had all of that inflation mixed in there, and yet the free cash flow from these companies was very significantly higher year over year at the end of Q2. That tells me that the shift is on and money is going to start to flow into them. We know the progression, right? And I'm sure your audience knows this as well. It always starts, money flowing into the metals first. We've definitely seen that with gold, right? Now we're going to start seeing money flow into the producers, and some of them are already really rocking and rolling. We follow Agnico Eagle. We think that's the strongest gold producer out there of the seniors. Their stock is up tremendously, and it's still going. Um, After that will be money flows into juniors and then, into developers and then juniors. We don't know the timeline of that. What I'm saying is that fuse has been lit, and it's just a matter of time until the money hits the juniors, and we start seeing, a lot of demand for their shares. Frankly, Gary, I think we could see some easy doubles and triples once that takes place, because not because the money's starting to flow in, but because the juniors have been so beat up and are so depressed that it would be nothing for them to just double.
So let's stick on this free cash flow item for a moment. As the price of gold has been rising, free cash flow, like you said, for the miners is rising. What are the implications for the miners as their free cash flow rises? And I believe those implications are positive. So, what are the positive implications for the miners as this free cash flow rises?
I mean, there's a lot of positive implications for them internally. Each individual company means they could pay down debt, they could buy back shares, they could increase their dividends, in any way to grow their business. They could expand their exploration programs. So each company is deciding for themselves how they're going to spend this extra cash flow. Kinross, for example, is really focusing on paying down debt. They said they're going to, one analyst said they're going to pay down as much as $1 billion in debt here, over the next year, simply because of greater cash flow from a higher gold price. That's it. I mean, that's amazing.
Wonderful.
So the other implication is that, of course, they could do M&A, and they're going to have more cash flow. A lot of investors in the junior mining sector have been like, these stocks are so low, they're so beat up, it would be so easy for a producer to come in and buy them at such a cheap price. Why aren't they doing that? Well, it's because they didn't have the extra cash flow that would normally allow them to do that. Now they do. So I do think M&A is going to start to pick up. I think M&A is going to be a major trend in this gold bull market. I don't mean just for the next 3 months. I mean for like the next 2 to 3 years. So M&A is going to happen. That's going to free up cash flow because of the extra cash flow that they have. So there's a lot of positive things. Ultimately, I think if you like juniors like I do, I think some fun days are ahead, and I think some of that is going to be because they're bought out. I hope it doesn't happen too soon, quite frankly, Gary, because I want my 5 and 10x first from these guys. So, but I think it's coming.
So, Jeff, what previous time period, if any, would you compare this one that we're about to enter for gold and the mining stocks? And are you expecting similar returns for mining stocks to that time period that you think is similar?
I think the similar time periods would obviously be the early 1970s. Another time period would be the, the late 1990s. And we know what happened with gold from 2001 to 2011. It was a major bull market. The reason I think we can compare to those big time periods, those big moves in gold and gold stocks before, is because of just how beat up most mining stocks have been, especially the juniors. I mean, a lot of these companies, they're sitting on actual resources, proven and probable resources, and they're trading for literally pennies on the dollar. I mean, they are literally dirt cheap. I mean, it's amazing.
Yeah.
So I think, that's why it's fair to compare to these other time periods, because they're just so depressed, and just any positive movement of funds into the industry, into the junior sector, is really going to ignite them.
So that's two very positive comparisons. So it seems to me like you think we're in the early innings, maybe even the first inning. The late 90s it preceded this big run. So you think we're in the preceding part of this big, huge run to come?
I think we've started it because of the gold price and how it's moving. But yes, I think we're in the early innings of it, especially because there's been relatively little to no movement in the juniors. Now they are starting to move, to be clear, and that's another positive sign that we're there. But this is probably going to be a mega bull market
Mhm.
because the whole commodity complex is poised to really run. On top of that, we have all the concerns about the economy, finances, geopolitics. All these things are converging to really support the gold price and drive it higher, which ultimately will drive the stocks higher as well. So this is really, I think this is the next 2 to 3 years are going to be very fun for us.
Perfect lead into this question. So, Jeff, in a stock market collapse, everything goes down with it, including the miners. In a market stagflation, where the market doesn't plunge, but also doesn't gain, it meanders along for months to years. The miners probably would likely gain really big there, the deeper that goes on, because more investors are going to realize, hey, we're not getting growth anywhere else. But
That,
predicting which outcome is most likely is near impossible. Is it going to plunge, or is it going to be, is the market going to experience this stagflationary, experience? So one thing we know, gold prices are elevated, the margins are widening, and profit is expanding. So what is your position here with regards to the miners? Do you sit on the sidelines believing for a plunge and then jumping in, trying to predict the bottom? Or do you keep a seat at the table without leverage, and regardless of what happens in the short-term volatility, ride it out over a period of the next several years, believing in the direction and ignoring the ups and downs?
oh yeah, obviously the answer is the latter. You can't sit on the sidelines because you think there might be a market crash. There may be, but there may not be. And I've seen many times where investors say, "Oh, I'm waiting for the crash," back when gold was, 1800. Look where we are now. So, since 2019, the gold price has more than doubled now. So look at all the things that we've been through. We had a recession, we had the COVID scare, we've had war, uh, you name it. There's been a lot of other issues as well, and yet the gold price has doubled. So there's been a lot of ups and downs. Now, if we do have a market crash, what we just had here a few weeks ago with the yen carry trade unwinding and causing that crash, that was short, but that's a good example of what can happen in a market crash, and that is that everything goes down, including gold and of course the gold stocks, because it's a liquidity event. When there's a crash, when it's an overnight waterfall decline, it's a liquidity event very quickly. And a lot of times gold gets sold not because the fund is selling it, but because they have to sell it, or it's automatically triggered and sold in that kind of environment. That's why it goes down. And so that's not something to really fret. When we know that, it kind of gives you power because you know what's happening and you know how to handle it. In fact, I use those times to buy. I bought the day of that crash a few weeks ago, a couple different stocks, simply because they were crashing and the value was very attractive right there. So you might say, I love big dips and I cannot lie, because I have made a number of very profitable trades simply because I bought the big sell-off. So, um, but you have to hang on and you have to use that as your opportunity. Actually, on this topic, if you don't mind, I'll just mention I went back and tracked all of the surges and sell-offs in the gold price in the last bull market from that 2001 to 2011 timeframe. There were 20 corrections in that 10-year period of time of 6% or more. So the average was 12%. Gold corrected on average 12% in the middle of a bull market 20 different times. If you take out the 2008 crash, it still corrected an average of 10%. So knowing that gives you power over the trend. It gives you the ability to withstand that because you know this is normal and you can use it to your advantage. So, I think people need to realize that if they don't already. And then for surges, the average surge was 21%. Just real quick, uptrends and blips up. So the average was 21%. So, you got to expect that. And so when things really get frothy in the middle of a bull market, you might take some profits and look for the next couple opportunities. But knowing these things can make it give you authority over the corrections and the surges. So
That's a
I hope
that's a
people will, yeah.
Yeah, that's an interesting way of putting it. So, if we were going to say, okay, how do you deal with volatility when you see a surge of 20, 30%, maybe pull a couple of chips off the table. And then when you see a fall of 6 to 10%, maybe put a couple of chips back on the table. Is that what you're saying?
Exactly. Exactly. Yes. Use it to your advantage. Expect the volatility because we don't control the markets. It doesn't matter what you think or what you believe about the markets. You have to take what they give you. And what they're going to give you is volatility to the upside and volatility to the downside. My point is make that part of your strategy. Use it to your advantage to increase your profits.
Yeah, that's fantastic. So, Jeff, silver's flirted with breaking out past $30 for quite some time. Silver's once again in deficit for the fourth or fifth straight year. New vehicle batteries have come out and they require more and more silver. In fact, Samsung, they just shared a new battery that they're going to be having go mainstream, and that one requires mass amounts of silver. In fact, some people are projecting that one battery alone will use 67% of all available silver supply once it's fully out there on the marketplace. Solar panel manufacturing, it's growing by leaps and bounds. They require massive amounts of silver, and modern military weapons, they require lots of silver, and they're proliferating around the globe. We all see what's happening, around the globe with all the wars. This doesn't even take into account the electrification of everything, artificial intelligence, data centers. There's just so much going on that requires silver. And with the currency and debt issues, silver is also once again being viewed as a monetary metal. So what does your analysis point to for silver and the silver miners?
Oh, well, I could talk about this for hours, but I'm very bullish on silver for all the reasons that you outlined. Industrial use is growing. Monetary demand for it is going to grow because of monetary concerns. I'll point out, some have claimed, well, silver's not really a monetary metal anymore. It's more of an industrial metal. And it is true that the use for silver is growing industrially. However, if you look at what happened in COVID, the COVID crash, both gold and silver crashed big time. And I bought very aggressively near the bottom of that, by the way, but it was very profitable for me. But when they bounced, gold rose 40%, silver rose 140% in the COVID bounce in like 5 months. So I think silver still has that outperformance of gold. It can be used as a fear metal, really a monetary concern type of issue. So there's going to be a lot of, once silver breaks through 30, which seems to be the ceiling now, once it breaks through that'll become the floor, and then we'll probably be off to the races. But I think, as most of your audience knows, silver does outperform gold, in bull markets. Sometimes it starts slower, sometimes it goes with gold, but by the end of the bull market, silver has outperformed gold. That's what the historical record shows. And of course, the silver miners will show leverage to that. They've been so beaten up as a small, tiny sector of the mining world that they're going to see some huge rebounds and bounces. Even some companies that maybe don't deserve, to see their stocks rise all that much, they're going to rise. So I think if you really focus on the strong companies, you're going to be really rewarded here over the next few years.
So if gold is in the early innings and silver lags gold, but ultimately outperforms, could we say that silver's really just warming up? I mean, the pitcher hasn't even thrown the first pitch yet.
Yeah, absolutely. That's for look at where the gold price is at record highs, and silver still whatever it is, 40% below its all-time high. So, I'm not someone who thinks silver's going to go to $500, or at least I hope it doesn't go to $500 because of what that would imply is happening in our world. But I am a believer in the triple digit silver thing. I think that's ultimately where we're headed. I'm not saying we're going to get there this year. And maybe we don't get there, but I do think we break through 50. And once you break through 50 at some point, whether that's this year or next year or in 2 or 3 years, there's a lot of air above that.
Oh, right.
Uh, from especially from a technical standpoint, there's nothing above it. So it's probably going to rise to 75, somewhere in that range, pretty quickly after it breaks 50.
And I believe the inflation adjusted price of silver is closer to $200. I don't remember the
Yes.
exact number, but
Yeah.
yeah. So
Yeah, absolutely. So, and it's just amazing what asset out there, what commodity out there is not trading above their 1980 high. I
yeah,
mean, it's ridiculous. One of the only ones is silver.
yeah.
I think microchips are cheaper now, but that's it, So at some point, this has really got to break, and when that dam breaks, it's going to happen very quickly. By the way, silver is very spiky. It happens very quickly. It happens suddenly. Sometimes it happens for not the reasons that we think it's going to happen, but it doesn't matter. It happens very quickly and suddenly. The average spike in silver is basically a double. So you need to be prepared and invested before that. Because if you try after, everything's going to be more expensive. And if you want silver, the premiums will be higher by then. So you have to invest not knowing when it's going to happen, but that it will happen, and you got to invest before that.
So the price of uranium, it's been running sideways for months now, and uranium miners have also run sideways to down in that time frame. Although today they're up very big after the announcement by Kazatomprom that they're going to miss production estimates next year by quite a bit. What's your analysis for uranium pointing to over the next 6 to 12 months, and what do you anticipate for the miners?
Yeah, they dropped their guidance by 17%, which is quite significant for such a large miner. I mean, something like 2 or 3% would be, understandable, but 17% is very significant. And that's why, as we see today, as you and I talk, the uranium miners are really jumping like Mexican hot beans. They're really soaring. So that tells you what's probably ahead for uranium. The uranium spot price really ran up into January and February really high, and until today has been in a pretty significant downtrend along with the miners. And now we're seeing potentially a reversal of that. One day, a bull trend doesn't really make. So I really look at the fundamental basic core picture of that. And there's a structural issue with uranium, meaning supply demand. Demand is growing, supply is not growing. You have geopolitical concerns that have major implications for the US and Canada and the miners. And that means those stocks are really going to be very attractive over the coming years. So, despite today, I would probably wait to buy on a dip, but despite today, I think this is something you need to have exposure to. If you don't, we've had a big, giant pullback for the last, 6, 8 months. So this is a time to get long of companies maybe that you missed or want more shares of or something like that, because this is going to be a long-term bull market.
So that's basically what I was just going to ask you. So in the mid 2000s, there was a lot of surges and a lot of drops, similar to what you described with gold. Are you expecting the same thing here with uranium on the way up through this bull market?
You mean volatility or?
Yeah, volatility surges higher, and then drops. Like we saw the surge, at the end of last year and into early this year, and then it's dropped back some, and now we could be on the cusp of another surge, maybe. But do you see this stair step kind of action going higher and higher and higher over time?
Absolutely, because again, it's a structural thing. There's not enough supply. Demand is rising. You have politicians behind this and frankly throwing money at it. You have the U.S. and Canada in deficit. I mean, they almost have zero production, right? So you have the green energy movement. You have many environmentalists that are behind it because it doesn't emit any carbon. So pick your reason. There's a lot of structural things that are going to support this market, and it's not going to end anytime soon. So regardless of how it happens, we had a big spike. It's probably more likely now we do have the stair step up. I think for me, my point is I want significant exposure to this market because I think the uranium miners, especially those in the US and Canada, are going to be direct recipients of this increased demand.
That's great. So when do you see big money, including institutional investors and Western investors, pouring into the natural resource and mining sector, and what will be the trigger for these folks?
Well, I think the trigger is already happening, right? You can't be living in the world and not see what the gold price is doing, right? I mean, it's on CNBC, and that's a good indicator that it's getting out there. The fact that the gold price is hitting record highs is getting out there, and so that's bringing attention to it. At some point, it'll be silver's turn. It'll be uranium's turn again. At some point, it'll be copper's turn again. Another one is lithium. The lithium price, that huge run up, and gave it all back. Literally every penny of that run up we gave back. So, but that's going to happen again because lithium is used in batteries. A lot of people are saying, well, the EV, demand is lower, and that's true. Well, guess what? Hybrid vehicles, hybrid batteries actually have more lithium in them than a straight EV battery, and hybrid cells are higher. Everyone's turning from EVs to hybrid. The lithium demand is not going down. So I want to have exposure to lithium miners as well.
So, and I heard you mention copper. So you're a bull on copper?
Absolutely. Again, you have another structural thing because you have not enough supply. There's lots of copper, but it's not enough to meet demand. That's the issue. And that gap is going to get worse. It's going to hit us here in the next year or two, and there's just not going to be enough. Now, again, we'll have a recession in there, and the copper price, I will point out, has never risen in a recession. Never. So you have that staring at us. But in the backdrop, you have this supply-demand issue that even if demand falls a little bit because of a recession, it's not going to be enough to match supply over the next 5 to 10 years. Some analysts think it'll be longer than that. So, it's a structural thing. I'm not worried too much about the recession. I'm not betting on the copper price itself. Anyway, I'm betting on equities that I think can still move their projects forward and make a discovery, big advancement of a deposit, enter production and get re-rated. There's lots of reasons why a copper stock can still grow despite what the copper price is doing. But again, the big picture, there's a structural thing there in that market as well, and that's going to drive copper higher.
So this has been a wonderful conversation. And before we wrap up here, and I ask Jeff our final question, I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled If you don't own gold, you know neither history nor economics.
Mhm.
This free gift is a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed this conversation with Jeff as much as I have. Please let him know, hit the like and subscribe button, and leave a comment below the video. It's now time for our Golden Nugget segment. Jeff, let's discuss portfolio positioning, understanding that you're not a financial advisor, and based on all that we've discussed today and with your experience and worldview as a backdrop, how are you positioning for the next 12 months? What assets do you like, and what assets do you absolutely want to stay away from?
That's a great question. Well, I think as viewers can gather from this conversation, gold, silver, uranium, copper, lithium, maybe there will be others. I'm really focused on. I want to own enough gold and silver to withstand any type of crisis. After that, I'm focused, pretty much on mining stocks. I mean, that's all we do over here is just focus on mining stocks. So, but there are mining stocks out there that can do well despite what the backdrop is, despite what the economy is doing, the general broad markets are doing. So we're really focused on individual companies that we think can make a big difference to investors and see a big rise in the share price. So that's what we're pretty much focused on.
Is there any asset that you're completely staying away from? Like you don't want to touch that.
Within the mining world, I'm not a nickel bull right now. Now that may change. I reserve the right to change my mind on that, and I would buy a nickel mining stock if it was, demonstrating that it was a good bet, a good speculation, because of something that they're doing with their company. So, but I'm really focused more on the others for now. We'll see how this all plays out. But I'll definitely be adding some companies as we go along, especially new ones that come up that are, have some exciting new prospects.
Well, Jeff, thank you so much for coming on to Metals and Miners, for being so generous with your time, your analysis, and ideas. It's really been wonderful to spend the time with you. Would you please share with the viewers any important message you want to leave with those tuning in, where they could learn more about your work and how they can connect with you?
Yes, thank you. Well, first, I wrote the book. You can see back there on the backdrop, Pay Dirt. I wrote that came out last year. I wrote that because there was a lot of people asking me, well, how did you pick this stock? Why did you pick that one? Why didn't you pick this one? So I ended up writing a book, and I even interviewed 16, I believe it is, other experts and included them in the book, all the way from the Rick Rules of the world, all the way down to the geologists you've never heard of. And they all give their input as well on each topic that I talk about as to how they look for specific mining stocks. The book has literally hundreds and hundreds of examples of stocks that have hit pay dirt throughout history. And I think that gives you a lot of, power to understand that this is a cyclical thing and we're at the beginning of another cycle, and it can really happen, that mining stocks can be very explosive. It's one of the few ways you can still be a venture capitalist, right? But everything we do is at thegoldadvisor.com. We have a free newsletter that covers, I believe it's 22 companies now, for free newsletter style, quality analysis on all of them on a regular basis. And then we also have paid newsletters. The Pay Dirt Prospector is my paid newsletter, where I'm really going a little bit more earlier stage, so a little bit higher risk, but also a little bit, greater potential reward. We also have Peter Krauth that came over. If those that don't know, I did buy Gwen Preston's business, so we have all of her business over with us now. Peter Krauth of the Silver Stock Investor also came over. He has a newsletter. In fact, we have a bundle where you can subscribe to both newsletters at a discount. So what I would say is that we are at a good time for someone to educate themselves, to really get prepared for what we believe is going to be a major bull market in gold and precious metals and other miners as well. It's a great time to get that education, to get your learning up to speed so that you're really prepared to capitalize on all of this. That's what we're focused on, and that's what we believe is going to happen. So we would love to see some people come and join us.
That's fantastic. I'm going to put all the information up on the screen and links in the description area for everyone to click through. If you're not following Jeff right now, guys, you need to follow Jeff. He shares, I've been following him since before I met him at the Rick Rule concert, at least 2 years before. And I've been, checking into a lot of his recommendations. I've watched some slideshows that he's done. He's very informative. He does a deep dive. He excavates on these stocks, and it's a great learning experience and an opportunity for everybody to improve their investment acumen. So I look forward to having you back on, Jeff. Thank you so much for being here, and everybody else, thank you for watching.
Thanks for having me, Gary. Let's do it again sometime.
Fantastic. I want to point everyone over to our Substack. It's free. Go to metalsandminers.substack.com. We post free content on the consumer economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They are all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote, and it's based on the important Ray Dalio foundational premise. It's titled, "If you don't own gold, you know neither history nor economics." This free gift is a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us.